Hello there. It's me, Stephen Thomas, with reports on housing coming to you from not sunny California, but rainy California on a Friday, November 14th. That's right, we're already halfway into November, and we are very, very close to the beginning of what we refer to as the holiday market. Across the United States, what happens is we will see demand and inventories plunge for the remainder of the year. Fewest number of homes come on the market in December, second fewest in November, and they're both come down at a very similar pace. So overall, the speed of the market doesn't change much, but do expect demand and inventories to fall rapidly until we ring in a new year. But anyway, we're going to jump into the housing debrief this week. The 50-year mortgage has been floating around like crazy. We wanted to put in our 2 cents and talk about the overall truth. And this is just by taking a look at what's really going on with the 50-year mortgage versus 30 and 15. And this really is all about affordability. And it has been extremely frustrating being a millennial or a Gen Z. They have had a really hard, challenging time getting into the real estate market. And that is just because during the pandemic years when things were going up like crazy, it was baby boomers and Gen Xers that were all winning. Very few millennials and Gen Zs were able to get in because they couldn't compete with everything that was going on. People were going way above the asking price. It was just this ridiculous time. And then after the pandemic went away, we had the inflation, and the Federal Reserve ratcheted up rates, and we saw long-term rates jump from 3.25% at the start of 2022 all the way to above 7% in the same year. And then they've been fluctuating between 6.5% and 7.5% for the better part of 3 years. Until recently, rates have definitely improved. But nonetheless, the administration has been trying to find solutions. They're throwing out various ideas. It's kind of like these test balloons where they throw it out there. But we love the fact that they're trying to look at different ways of making it easier for millennials and Gen Zs to get into the housing market. But we want, and then they announced this, that thanks to President Trump, we are indeed working on the 50-year mortgage, a complete game changer. And this is Pulte. And he is talking about the floating out the idea of going from a 30-year to also including a 50-year mortgage rate, getting there another option out there where payments would come down a little bit. But we're going to get into the nitty-gritty details because there's nothing better than facts and data and stats and that type of thing so that you can make an educated opinion, not just hearing what people are saying, but actually seeing what the differences are for just the common person that's out there. So we're going to stick to just the facts, and that's what it's about, is really drilling down the facts. And you could see 30-year mortgage rates. This is as of today. This is the end of the day on Friday, November 14th. We were at 6.38%. That's with no points or anything for a 30-year mortgage. So 6.38%. And this is from Mortgage News Daily. It's just the average interest rate with no points across the United States. And then you have 15-year rates. Now, there are 15-year mortgages as well. Now, they're not at 6.38. They're at 5.86%. But you have to amortize that over a period of 15 years. That's half the amount of time as a 30-year mortgage. So you're going to be paying actually more for this mortgage, even though it's 5.86%, because you're going to pay it off quicker. And so we're also going to discuss 50-year mortgages. And the implication, you can see there's a difference between the 15 at 5.86% and the 30 at 6.38%. The reason why the mortgage rate is more is because there's more risk. It takes longer to have more equity in your home, and there's more risk that the bank takes on by taking on this longer duration loan. Now, in a 50-year mortgage case, it would be even a longer duration. It takes much, much longer to build any kind of an equity position in the house if values were to go sideways. So there's a lot more risk that banks have to take on. So if you have this the same difference between 15 years and 30, from 30 to 50, you're probably looking at an interest rate right around 6.9% today versus the 6.38% 30-year mortgage and the 5.86% 15-year mortgage. Now we're lining all those up. So this is the 15, 30, and 60. And yes, there are different rates, and that is because of the risk. There's less risk for the 15-year mortgage, and that is, it has to do with the risk appetite as to where the pricing is. That's where investors will pick it up. And if you see what the different monthly payments are on these, for a 15-year at $650,000 with $520,000 down, a down payment, that's 20% down, you're looking at a payment for the 15-year at $4,349 per month. For the 30-year mortgage, you're looking at $3,246. Now, I know that that's a big difference, but you have to understand that 15 years, that's 12 months for 15 years, and you're paid off. You're totally done. The other one, it's stretched out over a 30 years, so twice as long. You're not saving half, but you are saving a bit, about, $500. And then you look at the 50-year mortgage, now it's $3,089 per month. And so that is a saving. It costs you $1,100 more per month for the 15-year mortgage compared to the 30-year mortgage. But once again, you own it free and clear and have no more payments after 15 years. The 50-year, it's $157 cheaper per month for that $520,000 loan. Now, a lot of examples have been going out there, and that's because they've been using the exact same rate. So the 6.38% for 30 years, they're saying for 50 years. And if you did that, if you had the same exact rate, well, then you save $362 per month, because you're not looking at 6.9% for the 50-year, you're looking at 6.38%. But you have to understand, there is a 50-year mortgage. Taking that on as an investor, there is a lot more risk. So as a result, it will come with a higher mortgage rate, and you're looking at 6.9%. Is probably a lot more accurate than being the exact same rate as 30-year mortgages. So do what, if you're actually going to peel back this onion as much as possible and do your own investigations, you're going to find out it's going to cost you more, the rate will be higher, and the savings won't be as great because of the fact that you have a higher mortgage rate. Now, keep in mind, you're making that payment right now of $3,089, which might save you $157 per month for the life of the loan. That's for 50 years, you're paying $3,089 per month. Whereas on the 30, you're paying $3,246 for 30 years. So for an additional 20 years, you're paying that extra $3,089. Now, before we go into exactly what that means and how much money is coming out of your pocket, I wanted to bring in our sponsor. And our sponsor is Mike Grambow from JMJ Financial. He can be reached at 714-794-7668. That's 714-794-7668. And that's Mike Grambow with the JMJ Financial, the Thibodeau Morel Group. And they have a fast close HELOC. It's a home equity line of credit. And it's AI-generated instant offers, electronic documentation, self-employed bank statements are allowed. And this is great for bridge loans to purchase a new home, debt consolidation, home renovation funds, need cash right now, could not get a HELOC from their bank, complex scenarios. Well, there is you can go ahead and scan this, and you can go right to it and get information right now and start that looking at getting an equity line of credit and utilizing the AI calculator and getting it done right now. So there's that QR code. Mike Grambow, JMJ Financial with the Thibodeau Morel Group. He can be reached at 714-794-7668. That's 714-794-7668. Now back to the program, and now we're going to talk about how much you will pay over the life of the loan, looking at the difference between 15, 30, and 50 years. And so when you look at it really close for that $520,000 loan, you have a 5.86% interest. It's just over 15 years. You're only making 180 payments. So it's not too long until you start to really pay down the principal. But the total interest paid is about $263,000. Now for a 30-year loan, now you're making a total of 360 payments. Takes a little bit longer to start paying down the principal. So the total interest paid is $649,000. Now, for a 50-year loan, you're looking at 600 payments, and it takes a very long time to really start paying down the principal. So it's a lot of interest up front, and you're paying $1,333,000 over $400. So that is a significant amount more than the 15 or the 30. And you could see this is lined up next to each other. It looks how daunting it is for a 50-year mortgage. And the difference just between the 50 and the 30 is an additional $685,000 that you're paying in interest. So there's a lot more interest expense that is paid. So, and you could see this is the difference between just the 15 and the 30, and you can imagine the 50 takes much, much longer before the loan is paid off. You can see after 15 years, paid off the red line, and then for the 30, it takes a lot longer to start really paying off, but once you start paying it off, about halfway, you're really paying down your principal, and it's paid off in 30 years. So, for the 50-year loan at 6.9%, you're paying $3,089. So if you're looking for a $3,089 payment, $650,000 house, $520,000 loan, so it would be better to wait for rates to come down a little bit. Or in this marketplace today, the market right now is a little bit more sluggish. There's a lot of homes that have been on the market languishing for a long time. You could probably get somebody to pay points. You pay points, you can get that interest rate down. And if you get that 30-year loan down to like 5.92% because the seller's paying your points, you already can make a difference, and you already have, at going from 6.38% to 5.92%, you have a $3,091 payment for that $520,000 loan, almost identical to the 50-year loan in the scenario that we just talked about. So just to get somebody to pay points, you can pay the exact same mortgage payment on a monthly basis, but just for 30 years, not 50. So, and there is some pressure and there is the possibility that if the labor market breaks, interest rates can come down into the fives. And we don't know right now because there's not been a lot of data with the government shutdown. It just recently opened up. We won't be getting all this data. It's going to take a while for them to start to get things going again. But let's say that the labor market is really breaking and we have negative labor reports. Well, what that will mean is that there will be a flood to 10-year treasuries and mortgage-backed securities. Will watch interest rates come down, and then you could be in the upper fives, and there you go. You didn't even have to do much. Or you can go right now when there's a lot more homes out there languishing and the seller is willing to pay some sort of points. See, I would look at different scenarios, and I would meet with a lender to see what exactly I can do to see how what's the best program for you. And I'd personally see what's the best program for me by meeting with a professional, and they can lay out everything so that everybody can make an adult decision. But after looking at all of the numbers and all that stuff, there's not going to be many people that are going to be saying, hey, you know what, this is a great idea, which is why a lot of economists have said this is just not that great of an idea. And you can already see that the administration's walking it back. This is Pulte. Head of the FHFA, and we hear you. We are laser focused on ensuring the American dream for young people, and that can only happen on the economic level of home buying. A 50-year mortgage is simply a potential weapon in a wide arsenal of solutions that we are developing right now. Stay tuned. The bottom line for me is, yes, I am really happy that they're at least looking at different ways of getting millennials and Gen Zs into a home. But we have to be careful exactly how we do it. One of the biggest ways we can get them into the home is to watch rates come down, because inventory has definitely risen over the last couple of years, which is a really good news. And values haven't done that much. They've been, for the most part, across the United States, kind of flat. So kind of flat values, and we have incomes going up a little bit, outpacing the pace of a lot of home values that have been rising, but just by a little bit. And there are some parts of the country, like we're in California, where it's been down slightly year over year. So we've had incomes go up, and now we have rates coming down, and we have a lot more homes on the market. That's the recipe for a really good market, and it's really good right now. So reportsonhousing.com, that's where you can go for to get more information. You can subscribe there as well. And we have reports that all over SoCal, the Bay Area, Phoenix, and Vegas. And the most recent report that came out along the coast, and the rest of the markets will get it next week, is called The Season's Silent Nights. And that is we're going into the holiday market where demand plunges, where inventory plunges. Very few homes come on the market in December, and that's the fewest, and the second fewest in November, and especially once we get into Thanksgiving. Actually, after this weekend, the week before Thanksgiving, it's really technically what we call the holiday market from mid-November through the middle of January, until we really start to see buyer activity ramp up when New Year's resolutions are gone, and now they can focus on housing. So that's the latest report, the Season Silent Nights, and you can utilize the coupon code 50 for a free month. Thank you so much for joining us for another housing debrief. If you're like me, it's raining like crazy, and so stay dry. We will see you on the other side the week before Thanksgiving. Thank you so much, and have a fantastic weekend.